This week, we're going to be focusing on the impact of oil prices on the GCC economy after that topic being specifically highlighted in our last webinar with Nouriel Rubini. This session is sponsored by FactSet, and I'm your host, Zachary Sefaradi, the CEO and founder of Down Capital and strategic partner of AIM Summit. Thank you so much for joining. We have in this webinar over 30 different countries participating. Amongst you are institutional investors, family offices, high net worth individuals, and other leaders of the financial services industry. We will be having a Q&A session after the presentations, but please feel free, use the dialogue at the bottom of your screen to type in questions as they come, and we will address them after the presentations in the session. If you're joining us via YouTube, then please like this video and subscribe to our YouTube channel now. Introducing this webinar is our partner, FactSet. FactSet is driven by two core values, innovation and partnership. For over 40 years, they relentlessly create open technology, delivering clean, transparent, aggregated data to their clients and designing solutions to be available anywhere and anytime. FactSet is proud to be recognized with multiple awards for analytical and data-driven solutions, both regionally in the Middle East and Africa and globally. Here with us today is Pascal Wazin-Papier, the Vice President and Regional Director of Middle East and Africa at AIM Summit. Before I hand over to Pascal, I'd love to share with you that actually here at Down Capital, we subscribe to FactSet. It's a great platform. Couldn't imagine doing business without it. The access to data, having it at your fingertips is certainly something that we think is an excellent value. It's really a great team that they have here as well. So I couldn't recommend it enough for those of you who are thinking about your data providers. So handing over to Pascal, who will be giving us a few opening remarks before introducing our speakers. Pascal.
Thank you, Zachary, and thank you also for the testimony. It's always this that drives FactSet. So thank you, Zachary, and thank you everyone for joining today. I'm really very pleased to be here. First, as you can see, it's my first day back in the office physically. And second, the year 2020 actually marks the 10-year anniversary of FactSet in the UAE. To mark this milestone, we wanted to continue engaging with our community. And to do so, we partner with yourselves and the AIM Summit to bring you 3 webinars on carefully selected subjects. The first one is, as you said, the impact of oil on the GCC economy. It resonates greatly with our client base in the Middle East and Africa region. So oil has been in the center of economic and political key drivers in the region, even more so since the start of the pandemic. We've seen a weak demand caused by lockdowns around the world, an oversupply, and a price war between Saudi Arabia and Russia, causing a historical crash of oil prices. I believe we all remember where we were when prices went down negatively for the first time in history. This new reality triggers many questions on how oil-dependent economies would react and cope with reduced fiscal budgets, and how the need of diversification of these GCC economies has been escalated and became even more urgent. But what will the diversification look like in this environment? What does this mean to the energy sector and the industry? And how is it evolving to cope with this new reality? Our panelists will discuss all these questions and share their insights into the topic. So thank you, Dr. Fabius Kassiabilani and Bart Cornelissen, for taking the time to discuss the impact of oil on the GCC economies. And without further delay, I let you, Zachary, to launch the discussion and introduce our speakers. Thank you.
Thank you so much, and it's congratulations on celebrating your 10-year anniversary here in the Middle East and in the DIFC. For those of you dialing to the webinar who recognize we're here in the DIFC in Gate Village, and I can see on all of the screens in the DIFC, FactSet has been the data provider, which has been really exciting, going up and down the elevators and getting up-to-the-minute information from FactSet, which has really been a great value add here in the center. So without further ado, it's my pleasure to introduce Bart Cornelissen, who is a partner at Deloitte. He's an executive advisor with over 20 years of consulting experience focused on strategic and operational issues in the natural resources space. He's worked with NOCs and IOCs across the entire oil and gas value chain with a strong focus on upstream and emerging markets covering, among others, Africa, India, Ukraine, Russia, and the Middle East. He currently leads Deloitte's energy, resources, and industrials practice in the Middle East across all client offerings. I've had a preview of the presentation that he's going to be sharing with you, and very excited to have you with us, Bart. Please.
Thank you very much, Zach.
Yeah, thank you so much.
Good. So let's get started. I will make sure that the presentation is up. Good. So Zach, please confirm that you can see it. I think I wanted to build up some of the elements that Pascal already mentioned, and I know
Sorry, Bart, we can't see it. It's not.
That's the share screen. There we go. Good. You should be there now, I think. I was saying it's like I wanted to build up on some of the comments already made by Pascal around what has happened in the region, and particularly the severity and the impact of it, and what are some of the implications of that. We've seen, of course, a drop in demand over the last few months, although it has recovered a little bit, still very much as a result of homework, no air travel, limited transportation. We really see a significant drop in the need for oil and gas products. And the question, of course, really, will this come back to levels pre-COVID, or are we in a new normal where we'll never see a peak of about 100 million barrels a day? And that's still to be seen. The jury is not out on that, but it has resulted in one of the worst crises in a long time. Everybody makes the comparison between 2020 with like 2014, 2008. But we have to understand that the previous crises were fundamentally different. 2008 was a financial crisis, had very little to do with the oil and gas industry in itself. 2014 was all driven by literally a few million barrels a day of shale oil and gas, totally creating chaos in the markets. Now we're talking about not 2 or 3 million barrels, but we're talking about 30 million barrels of a drop. So you can see the magnitude of this. And that really is driving, not only around the world, but also, especially in the Middle East, the GDP down. And what has happened, and I think that's particularly interesting here in the region because of the importance of the oil, gas, and chemicals players, is that all the major players cut basically their spending back by about 20%. You might have seen the announcements when this started. ADNOC and Abu Dhabi basically told its suppliers, we need to cut costs by 30%, and made sure that the same services were delivered at significantly lower prices. But that expenditure is important because this industry is so important for this region. At the same time, we have seen a number of players cut their dividends, particularly Shell as most noticeably the one. At the same time, as you've seen that Saudi Aramco has actually maintained the dividend, but had to increase its debt to do so. So in the industry, really significant changes on expenditure as a result of the drop in demand. And this expenditure, as I said, is important given the importance of oil and gas and chemicals in this region and the economic impact that it has, we're speaking about today. And it has also created, and I know Dr. Fabio will talk about it a bit longer later on about the supply and demand, but one of the interesting things of this is that in the old days, it was really difficult to have a renewables project that was on par from a return of investment perspective with an oil and gas project. Not anymore. So one of the questions I made, the comments I made earlier around, will oil demand actually recover to the levels before? There is a scenario possible that it definitely won't, because it is actually not that lucrative anymore to invest in oil and gas. It's far better to actually make investments in renewables. And we see some of that already happening in the region, with the UAE having one of the largest solar farms built out in the desert, and Saudi Aramco in the process of even building a bigger one. And we talked about a bit like why is this so important for the region? Is, as you can see on the left-hand side, where we look at, if you think about the fiscal budget where is the money coming from? And if you take the region's average, it's more than 60% coming from oil and gas. The only exception to that is the UAE, but to be very honest, there it comes from financial services, airlines, and tourism, which, as you can imagine at the moment, are not the sectors necessarily that are contributing a lot positive GDP either. So, because a lot of that is interlinked with what is happening in the rest of the region. So, and because it's so important, the importance also of the oil and gas prices on the fiscal break-even price are significant. So what do we see? That it's not only that you're dependent on a lot of the oil and gas revenues, but also that you need a price point significantly higher than the current price point in the market. It's, if you take particularly the largest economy, Saudi Arabia, they need about $80 a barrel to break even their budget at the moment. And that's the current price. That's actually a little bit higher now. It's about around the 40s, but that's still very far away from where it should be for Saudi Arabia to break even its budget. And I think that comes to the core of the question we're talking about today. What do you need to do? Because you clearly cannot keep your spending the way you're doing it today up with the income you get out of your oil and gas resources. And this, of course, comes at a time, and I've just taken here Saudi Arabia as an example, but you will see, as you know, if you're in the region, besides Vision 2030 in the Kingdom of Saudi Arabia, effectively every economy in the region has a similar kind of strategy. The core is always around education, diversification, and empowerment. And that made sense, and that ambitious journey was set really pre-COVID. The only issue with it is it's a very expensive journey. And the question now will be, given the lesser income that the governments in the region will have, how do you adjust that strategy or that vision? Where do you make your compromises? Where do you focus upon? And that really leaves a few options for you to take. Is, yes, you could potentially continue in the hope that the oil price will go up, but you take a risk there if you take that scenario. You can also slow down, scale back, but even consider acceleration. So perhaps this is the time to diversify even faster than you've been doing in the past, because it's clearly showing that you can't use oil and gas anymore as the nesting egg for the future. And how do you as a government respond to this with a resilience to make sure you create a sustainable, robust economy going forward? Is to really think about, what are your current fiscal needs and challenges? What strategic direction do you want to take? Where do you want to position your country? What are the areas you want to focus upon? Then what does it mean from a governance, but also from a social economic perspective? Because there is a social contract between governments and citizens on what you're supposed to deliver and what they would expect. And then last, what investments and policies would you put in place to enable all of this? How do you ensure that the investments are made in the right way? What kind of partnerships do you set? And how do you think about some of the structural reforms you have to put in place? These are some of the questions we need to answer in the years to come. It's, as I said, there is not one silver bullet, unfortunately, because it's not one scenario. There's many different ways you can think about the oil price crisis. It can go quickly, you go up again. It can take a long time. It's depending on what level it peaks at. Will it be 100 million barrels a day or higher compared to what it was before? Or will we level off at 80, 85? And these are important questions because they will drive, to a large extent, what the amount of money available in the region is to drive these programs of social change. So I want to leave it here, so to leave the floor to Dr. Fabio, but thank you very much. And I'm looking forward to any questions you may have. Thank you.
Excellent. Thank you, Bart. I can already see several questions coming in on the dialogue. Please feel free to send questions as they come. Bart, also, I assume that we'll be able to share with the audience members your slides after this presentation?
It would be my pleasure for them to share, and if they have any questions, I'm happy to answer them also.
Excellent. So the AIM Summit team has a copy of those slides. So for those of you who have asked, yes, those slides will be distributed to you. For those of you who are viewing this on YouTube, you can also contact AIM Summit or download the slides from the website. Great. So it's an absolute pleasure to also introduce one of our AIM Summit alumni, Dr. Fabio Scacciavillani, who's a managing partner at Emmental. Dr. Fabio is a PhD in economics and as a partner at Emmental, an investment bank assisting innovative startup and growth companies to access the international capital markets. He was previously the chief economist and chief strategy officer of the Oman Investment Fund, a sovereign wealth fund of the Sultanate, where he developed macroeconomic forecasts, conducted analyses of global trends, and as member of the investment committee, contributed to the implementation of that sovereign wealth fund's investment strategy. Previously, he's been a director of macroeconomics and statistics in the Dubai International Financial Center and was an executive director at Goldman Sachs, a senior economist and advisor at the European Central Bank, and he's held various positions at the International Monetary Fund. He's the co-author of The New Economics of Sovereign Wealth Funds and has published several seminal papers in academic journals. Dr. Fabio, it's such a pleasure, as always, to have you back. Very excited to have you with us today and to have this presentation, particularly given your background, having sat on the side of the table with the sovereign wealth funds and the depth of knowledge that you've developed as a result of that experience. So thank you, Dr. Fabio. Certainly, again, a pleasure to have you.
Thanks, Zachary. It's a pleasure and honor to be again speaking at one of the AIM seminars. I will share my screen so that you'll be able to see the slides that I prepared. And unfortunately, the title is not very cheerful. It's the GCC Bleak Picture. The main issue here is what we heard already from Bart, and the slump in global hydrocarbons demand is the key driver of the economic performance of the GCC now and probably in the foreseeable future. The government finances have taken a hit because I don't make a very original statement by saying that most government revenues comes from hydrocarbons exports, and whatever other non-oil drivers of the economy, for example, logistics in Dubai, tourism in Oman, and refining, oil refining in other places, has also taken a hit and will not recover anytime soon. So out of the GCC, the countries that will be most adversely affected are the UAE because of the global recession, and Oman, where together with the UAE, the tourism share in the GDP is quite large. The macroeconomic forecasts that I've taken from the Economist Intelligence Unit, but because they are the most updated, those of the IMF date back to June. But as you see, Middle East and North Africa will take a hit of about 6.1% in GDP growth this year and will recover slowly to regain the 2019 level over 2 years, probably, in mid 2023. If we look at the two major economies of the Middle East, we see that Iran will be negatively affected, and this will be the third year in a row of deep recession. Saudi Arabia will take a blow of 5.2%. The IMF was estimating 6.8%. And here again, the recovery will be the recovery to the 2019 level will take about 30 months. Now, fiscal projections are equally, I don't want to say disastrous, but definitely worrisome. Now, let's, how can I say, move from the beaten path to the to some not so conventional considerations. Now, the strategy that GCC countries have put in place to fight the recession is unfortunately not new. It's the typical austerity plus borrowing that has taken place in the past. And it's a short-sighted strategy because the essence, the change in the fundamental depends on the demography. While in the past, the number of barrel of oils extracted could comfortably take care of a few million, in some cases, few 100,000 people. Now, with the demographic picture, with the demographic pressure increasing in many countries, Oman is a point in case, the oil extraction is not enough to sustain the lifestyle and the economic model that has prevailed until recently, until let's say 2014, 2015. In the strategy of substituting local citizen in jobs is not going to work, because you need foreign talent and foreign human capital to give a boost to the GDP once the recovery starts. But we need also to understand one thing that is not, I would say, that is neglected. When I was in Oman at the Oman Investment Fund, I was asked by several international fund managers to give them an overview of the country perspective, the debt sustainability. So they were inevitably asking me, what is GDP in Oman? And my answer was invariably, I don't know, and I don't care. Because if you are an investor in government debt, the GDP of Oman or any of the GCC country is not an indicator of fiscal capacity to repay the debt. Okay, what is important is the oil revenue and therefore the oil price. By the way, the GDP estimates in the GCC are biased. Why? Because there is no income tax system, and only recently in some countries there has been a VAT system. So if you don't have data, like microeconomic data from the tax system to get an estimate of GDP is extremely difficult. You have to send surveys to major producers, major companies, but you underestimate, for example, the services sector. and therefore it's just a very rough, a very distorted indicator of economic activity, what we call GDP. And as I said before, it's not even a good indicator of that sustainability, because until you have a taxation of income and an effective taxation, an effective tax system, you will not be able to raise money to pay for the accumulated debt. So if the GDP is not an effective indicator of economic activity, how can we understand what was the effect of the pandemics on the GCC accounts? Well, I've taken the mobility tracker by Google to give you an idea. This is the tracker. Down here you'll see the source of this data. The tracker for the UAE. So at transit station, like let's say bus and other public transportation hubs, the traffic has gone down compared to the period 3rd of January, 20th of February 2020 by 38%. The movement on workplaces has gone down by almost a quarter, which doesn't mean that a quarter of people don't work. It means that maybe some is still working in remote mode, but this gives you an idea of how the lockdowns and restriction to mobility have affected the economy. If we look at final resolution and we look at Dubai, we see that the situation is even worse. We have here, I took all the various locations from retail, retail and recreation locations to workplaces to public transport to residential and so on and so forth. So this gives us a timely indicator, not so much of the level of GDP, but it gives us an idea of when things will go back to normal. Okay, so this is a more effective way of tracing economic activity than waiting for the GDP when data will be available, which will take a long time. I've done the same exercise for Oman. This is the Muscat Governorate, and you see that the orders of magnitudes are comparable. I won't go through each and every of the slides that I've prepared. You will have those who are interested can get the presentation and look at it by themselves. So here, Qatar. Now, will the sovereign wealth funds assets cushion the impact? Well, to a certain extent, yes. For example, countries like Abu Dhabi, Qatar, Kuwait have enough money to sustain the current to support the current economic environment, but Oman, Bahrain, and to some extent, to a lesser extent, Saudi Arabia will not be able to sort out the situation by even if they were to sell all their accumulated assets in sovereign wealth funds. So that's why they need to borrow more aggressively. International access to international borrowing is still relatively easy. So there is no vulnerability in the short run, but especially Oman and Bahrain will need to more prudent because, as Bart said, in the over the next few months, there won't be a rebound in oil prices because oil stockpiles at global level remain within comfortable levels. So you have to exhaust all these inventories before the oil price can sustainably move up, which will happen probably over the mid-2021. Okay, once we have a vaccine against COVID, and most of the world population will have undergone a vaccination. Risks are on the downside if contagion numbers pick up towards the end of this year. For example, we've seen that Israel or France and Australia as well are experiencing a second wave or a resurgence of the first wave, depending on which virologist you want to listen to. But essentially, things can worsen considerably. To regain a level around $60 per barrel, I think we'll need to wait until 2022 if we believe the let's say the baseline scenario and the most accredited estimates. But at this point, let me, point out that these forecasts are based on a linear model because those are are easier to handle, are supposedly being developed over the years, so should be more accurate. I'm not sure that is the case. Why? Because what drives the dynamics in the oil market and in general in all commodities where you need time to adjust supply to demand conditions, the kind of dynamics that depend on the relative slope of demand and supply curves. So if demand is less elastic than supply, fluctuation can grow out of control. In the if the supply is less elastic than demand, then the adjustment process will converge to an equilibrium point. But what is important is that when you have these differences in the relative slope of demand and supply, by the way, this is a model, very old model. The source here is Mordecai Ezekiel, the Cobweb theorem. So it's a study of 1938 that has been very famous, has been the graphs here are taken from the original publication. It has been analyzed in a countless number of studies. So this is, let's say, the simplified version. But I'm presenting it here because it's still the best, illustration for those who see it for the first time. And the bottom line is that the time series of price and quantities in the oil market tend to be quite non-linear. So what I'm trying to say to translate the model into the reality is that if, for example, the fracking industry in the US will be severely hit by this slump to the point that they have to close all the shale plays, then you will see, even in the face of lower demand, lower structural level of demand, you will see an increase in oil prices because supply will not be able to catch up. And as Bart was saying, because the investments in oil exploration, oil extraction, oil facility, etc., might not be at present very attractive. This means that in the medium term, the supply will decrease. Therefore, it's not unlikely to think that we might see a level of $80 per barrel earlier than we think if the world economy rebounds once the vaccine is found and the population the general population will be less scared of returning to the old habits. So, for example, the presidential election will be a key element in the supply dynamics, because if Joe Biden wins, then the frackers will have a tougher time. And although the new Green Deal will take some wind off the hydrocarbon industries, it will take time anyway to reduce the demand for hydrocarbons. I think that I will stop it here. Maybe there will be, if there are questions on diversification and where to go from here for the GCC, I will devote more times to what needs to be done in terms of policies to reduce the GCC dependence on oil carbon. But I think I've taken too much of my time already, so I'll give the floor back to Zachary.
Excellent, Dr. Fabio. So we have a lot of questions coming in through the Q&A session. We'll start with a question for Bart. So Bart, one of Kashif Saeed has asked, when you see, if at all, renewables completely replacing fossil fuels and meeting energy demands, is that an outlook that you see, or do you think that replacement will be more marginal? You're on mute. It's just
one thing to realize is that we're all talking about, similar as Dr. Fabio was saying, we're talking about scenarios. It is a potential, yes, that it will go fast, but I think one of the key things with the energy transition to realize it really is more of an evolution than it is a revolution. We will not see renewables, and particularly in the Middle East, where at the moment it's about 2% of all energy consumption, take over oil and gas. And that's not a question of just power generation. Above all, it's about storage and about distribution. Large parts of the world do not have the infrastructure to deal with electricity. And as a result, diesel generators, fossil fuel cars will still be very much part of the picture. So I think that I won't witness anymore the days that there is not a need for fossil fuels in my life. So I'm saying is you need to look at least a number of decades out before you can talk about that. And particularly also because a very large component of oil and gas ends up in other chemicals where there's no real alternative yet. It is used for things like air transportation, no alternative yet. Shipping, not really a feasible alternative yet. So it will take time for the innovation to pick up and then for storage and distribution to be put in place. So I think it's going to take a long time.
Yeah, and as world populations do continue to grow, the underlying baseline energy demand is obviously increasing. How much of that is going to fossil fuels and how much of that is going to renewables will rely on the pace of the energy transition. Certainly, the Sustainable Development Goals are pushing for that energy transition to be accelerated. But I think in terms of investment, we are far behind the levels needed. This is a question from Rajiv for Dr. Fabio. He's asked about a forecast where oil prices return to $70 or $80 a barrel. Do you see fracking then making a potentially big comeback? Fracking has been an outsized impact in terms of the capex cuts. Overall, we've seen between 100 and 150 billion dollars of capex cut, but a huge amount, percentage-wise, has been realized by the more expensive sources such as fracking. Do you see them making a comeback at 70, 80? When do you think that they come back and storm? And do you think that that potentially puts a ceiling on the oil price?
I think that the fracking, but I've said that for several years, is a loss-making business because it's very expensive, and it has been possible to expand the production from shale plays only because these loss-making companies have been kept alive by loans, by credit, extended by Wall Street for lack of better alternatives, and because of the political drive to tout the US energy independence with Obama and then with Trump. Now, I think that at some point people will realize when the Federal Reserve will stop buying junk bonds and giving money to keep alive zombie companies, that fracking is not sustainable. And therefore, these 3-4 million barrels a day of production that have been dumped on the market in recent years will be eliminated. Now, how long will this process take? I don't know. Depends, as I said before, on whether Biden or Trump will win the election, because this is a hot political potato in the US, both from the environmental point of view and from the energy independence, nationalistic point of view. So, but in addition to the fracking woes, you have an effect coming from the conventional oil extraction, where investments have been dwindling for years. At some point, this will have an effect on supply. And once the cushion of oil inventories will be exhausted, then you'll see a rapid pickup in prices, as we saw a rapid downturn in price, because it's the nature of the oil market in general, of commodity markets, as I explained. Unfortunately, it's difficult to time when these upswing or downswings takes place, because it depends on expectation, perception, storage, and a number of other elements that are difficult to forecast. But I would be surprised if in 2023, let's say, we won't see an oil price closer to 80 than to 50 or 60.
Now, I certainly recall a lot of similar comments, particularly when oil prices have, a few years back in 2015, 2016, were first suffering a pretty dramatic decline. But one of the things that surprised everyone and most forecasters, not only from the fracking side, but from the conventional side, was the impact of technology. And the ability of producers to increase the efficiency and extend the productivity and life of existing assets. A question for Bart, given that you're advising several of the NOCs and IOCs, from Antonio Antonuccio. He's asked whether the NOCs or whether the IOCs or whether you're seeing particularly regional players increasing investments in technology to increase productivity of assets and extend their usable life, and the impact that that has on other players in the sector that you might be consulting.
Now, what is very interesting is that we've seen a lot of players in the region cut their spending quite a bit on large capex, like the longer term projects. At the same point in time, investments, for example, in a digital transformation have hardly reduced. So the investments in technology, and I'm not only talking about OT, like operational technology, but also information technology. And these days, to be honest, they are fully merging into each other. There's almost no distinction to be made. We clearly see those investments being kept up, but with a slight shift where in the past, there was a lot of appetite for like the long-term transformational investments in technology. We do see now that the players in the industry want a far faster return on investment. So the more transformational visionary projects have been replaced by real day-to-day operational improvements that can cut costs in a relatively short time frame. But technology is definitely there. And it's been also, as Dr. Fabio was talking about, and you were talking about this also, Zach, it's been at the core of the shale revolution, and it's also at the core of determining who is the last man standing. Because we all know that the oil price will eventually, and the demand will go down, eventually the demand will dry up. And the question then becomes, which player will stand up? And those are the ones that can have the total cost, and that's lifting costs, capex, and so on, at the bare minimum. So, for example, the region I come from and I worked for years in the North Sea will probably not be alive by then anymore because they are at the high end of the cost curve. Shale is interesting because it's very spread. It comes at very low cost, but it also has very high cost fields. So you will see different fields might survive, perhaps not at the production levels that we're used to, but some of them will. But coming back to the question, technology investments definitely still very strongly going on.
Let me add one thing, Bart, on this point. Who is the last? I mean, the oil price will depend on marginal cost. So yeah, it depends on the cost curve. You can have a very, flat cost curve, or you can have a cost curve that, suddenly jumps up. So for a relatively little increase in demand, you might see a substantial pickup in price. Yeah. We don't know yet what will be the end of the story, but it's important to figure out what will be the cost curve of oil extraction once this slump, this COVID recession will be over.
Yeah, and so one of the ways we do that, and we were talking earlier about the use of data, we actually do the analysis oil field by oil field globally, because you will find is that the mix, it's not like shale is expensive, Middle East is cheap, North, no, it's actually very mixed. And you can actually determine as a result what that curve is, as Dr. Fabi was talking about, and also explain why in 2014, a few million barrels had such a massive impact on the price. And why, funnily enough, now the far greater drop, at some point there's a level it stops at. For the simple reason that there's a lot of fields at that price point.
So a question for both of you. there have been a few questions on the Q&A. One from Carl asking about the strategy of the Saudi PIF, the Public Investment Fund, and their strategy to diversify investment. Now, we're far enough into Vision 2030 that we should be seeing some real impact on the ground. Dr. Fabio would love to, again, hear your insights into this. We saw the Aramco IPO happening. That was one of the central pillars of the PIF's plan to diversify the kingdom's economy. So what is the real impact that you're seeing on the ground of Vision 2030 and PIF strategy for diversifying the kingdom's economy? Is it working? Is it going in the right direction? Is there progress? It would be great to know some of the impact that this is having on the GCC's economy and particularly on Saudi's economy. Starting with Dr. Fabio.
I have the impression that it's not working. Let me go back to the slides I had presented. The effort to diversify the GCC economies started, let's say, in the early 70s now. 35 years after that, we don't see much, with some exceptions. I mean, I would say that Dubai is the most blatant example that things can be achieved. But the point is, first of all, in the middle economies around the world, it's difficult that rely on commodity export. It's difficult to diversify because the commodity sector pays attractive wages. So if you want to, say, develop a domestic industry, you must pay market wages which are above the world wages for industrial companies, and therefore it's very difficult to keep up with the productivity equation. Second point, in the GCC are a very small market. So, for example, we try to attract the automotive industry in Oman, and the answer we got was always, the market is too small. We need a market of at least 100 million consumers to be able to justify setting up an automotive factory with all the suppliers in the GCC country. The third issue, is the human capital challenge. Nowadays, if you want to diversify, it wouldn't be wise to diversify, say, in textile or steel mills, because there you have already an overproduction, and the key competitive factor is the wage rate. So unless you want to import additional people from the Indian subcontinent or other Arab countries, it wouldn't make sense to try to diversify into traditional sector. You need to diversify into high value added sectors such as, I don't know, IT, green energies, artificial intelligence, if you want to look further away in the future, big data, fintech, and so on and so forth. But to win in these sectors, you need to form competencies within the GCC countries. In other words, you need to improve greatly the education system and the university system. Nowadays, they are not up to standards that would be sufficient to diversify into the futuristic industries, in the futuristic sectors, in the high value sector. And that is the real challenge that Saudi Arabia, but also Qatar, UAE, and all other countries face. And that's why so far the success and tangible results have been elusive.
So Bart, same question. I mean, what have you been impressed by the PIF's moves, or are you also skeptical? Do you think that things are going in the right direction? Has it had an impact? Are you seeing this? Are you seeing these projects moving forward? Are they going to have the diversification impact, the multiplier that's expected, or do you think they're bound to disappoint?
I think there's a few elements to it. Is one, it's not only what they spend on those projects. At the end of the day, they're an extension of the government, and the question then becomes, what has been the total government spending? And when we look at it in the region, still a tremendous amount of part of the government spending is consumption driven, which is subsidies for fuel use. If you think about energy usage, if you think about water usage, if you think about education, so there is a change needed also in the social contract, because you not only want to be able to invest certain amounts of money into the mega projects and the other investments you're doing, but you also need to cut your costs. You need to, because you can only spend every dollar once. The second thing with that is, when we look at the portfolio, is where do they spend upon? And one of the interesting choices, for example, in Saudi Arabia, is in tourism. A tremendous amount of investments are made in tourism. And the question there becomes, what is the local market or the regional market to actually sustain all this tourism? Because you can see it already very simply between Abu Dhabi and Dubai, that it's very difficult to get tourism really off the ground in Abu Dhabi because Dubai is next to it. And the question then becomes, is there another need for a resort in the Red Sea, another one on the East Coast? It's very, very challenging. So I support Dr. Fabio's comments around, like, anything in the manufacturing space is extremely difficult because there is no local market, or it's a very, very small market. You're not the subcontinent, you're not China, you're not Europe. So what manufacturing of scale can you put here? And then it comes, and we are working as a firm also on a lot of these issues around education, but education also means not just giving people the skills, but also the culture to actually strive to be involved in those jobs. And there was earlier a comment made by Dr. Fabi in his presentation around the use of expats. Yes, expats need to be phased out, but at the right time with the right people. You can't do that overnight, but eventually all of us should be phased out by people from the region who have the right skill set. But that's something that will take decades because it's about generational changes. So I'm less, perhaps not as bleak as Dr. Fabio said, but I still think there's definitely major challenges.
Well, we are actually out of time, but I will squeeze in one last question for this question has been directed to Bart from Carol van Randwyk. So the question is around the impact on financial services industry from low oil prices. As we've seen, the financial services industry can create systemic risks and systemic impact when it suffers from one industry. So have you seen that happening with some of the aligned interests and growth in national governments, national oil companies' revenues being linked to wholesale banking, reduction in oil prices, reducing GCC financial services industry activity, and potentially having a knock-on effect in other sectors?
And the knock-on effect, in my opinion, will be primarily because there will be a reduction in the size of the economy. At the end of the day, financial services, to a large extent, is driven by how much economic activity we see in a region, like the GCC. And when we look at the scenarios going forward, some of them mean a significant reduction in GDP in the region, and as a result, also less need for financial services. And that's not only like investment banking, but just even retail banking. It's if there are less people in the GCC, expats are leaving, for example, because economies are smaller, that will have a direct impact on the financial service industry.
Yeah, so we're obviously seeing that as well, and couldn't agree with you more, Bart. Both Bart and Dr. Fabio, this has been an incredibly insightful webinar. Again, being based here in Dubai and in the GCC, even if you are not in the oil industry, you always have one eye on the oil price, because you know that as well diversified as some of the economies out here have become compared to their past, it still does have a knock-on effect. This year, again, people have referred to as double pneumonia for countries in the GCC, having suffered the impact of COVID and then having a double effect from the impact of the price of oil on GCC economies. So it's been very helpful to understand, again, some of the market dynamics. We discussed potential oil price recovery, how CapEx plays a factor in the lag on supply side elasticity. We discussed how some of the region's economies have been attempting to diversify themselves, and some of their sovereign wealth funds have been implementing strategies, but the challenges that they faced and the potential for focusing on the right sectors. Ultimately, again, looking to build economies that can potentially survive in days where oil, the production of oil will potentially be lower than it is today, and a potential scenario where we have had peak oil demand come and go. Thank you again very much for speaking. I will hand over to my colleague Pascal for some closing remarks. Pascal.
So yeah, thank you, Zachary, and thank you for our speakers. It was, I echo Zachary, it was very insightful. I took a lot of notes. I will mention something that I found very significant for our industry is both speakers mentioned digital transformation and big data, AI, and we see the same thing for us in FactSet with the large projects that we are underway doing in Vision 2030, for example, in Saudi. We do the same thing, and we see the trend also in our book of business. So thank you very much for the speakers for taking the time to come today. Thank you, Zachary, and I hope we see the audience again next Monday.
Yes, thank you very much to all of our audience members. For those of you whose questions were not answered, we will share them with the speakers and hopefully be able to provide some follow-up answers. As Pascal has mentioned, we will have another session next Monday focusing on hedge funds, active versus passive. Is active management making a comeback? This has been one of the discussions and one of the topics that we have covered year after year at AIM Summit. And every year, the story has progressed one way or another. But active management is definitely making a comeback. We will have two excellent speakers presenting on different sides of this debate. We have Kier, Boley, who's the co-head and CIO of Alternative Investment Solutions at Union Bancaire Privée. And we'll have Farouk Jivraj, who is the head of investment strategies at Barclays Investment Bank. Barclays has been one of the leaders in this kind of passive management trend. So it will be very interesting for those of you who are able to join. And we'd love to hear from the audience. What do you think? What are your thoughts on active versus passive? Is 220 over? Is it worth the extra fees? Can you generate similar returns from smart beta products, from passive products? So that will be in line for the discussion, and certainly something central to FactSet being a data provider. Again, thank you so much to our speakers, to our hosts, to our sponsored FactSet. This has been a very insightful webinar. For those of you who've joined on YouTube, please like, please subscribe, please add your comments below. We'll be sure to engage on them. And we really appreciate everyone who's joined us for this webinar. Thank you so much.